Good afternoon.
Every few weeks, the world waits for the Fed. Traders are glued to their screens, newsrooms go live, and everyone braces for impact. But what if that entire event, the announcements, the numbers, and the chaos isn't about informing you, but it's about moving you? What if I told you that a small algorithmic event in price action would be the focal point of a major move to unfold? Only that event took place over 3 years ago. This is the hidden choreography between time and price and the markets, and how news events are used as a smokescreen to manipulate the crowd. Now, I know it seems far-fetched. I will jump onto a chart and show you what I mean in a second, but sometimes the truth is madder than fiction. In the world that we currently live in, the deception really shouldn't come as a surprise. See, the FOMC, the Federal Open Market Committee, sets the cost of money. Basically, interest rates, projections, and tone. But here's the truth. The market doesn't wait to hear what's said. It's already positioned for the moment in time when that statement drops. Because for the algorithm, the words don't matter at all. The timestamp does. It's not reacting to the speech. It's executing the intersection of time and price. It's used to engage liquidity. The thing is, almost every high-impact event follows the same pattern. A two-part trap. Part one, the fake move. Price runs violently in one direction. Stops get triggered, breakout traders pile in, the crowd feels confirmed just long enough to get trapped. And part two, the real move. Once that liquidity is harvested, the algorithm reverses, running price to the other side of the range. When the news hits, humans think in headlines, right? Rates unchanged, dollar spikes, makes sense, it's comforting, it feels logical, but the algorithm isn't logical, it's mathematical. It uses logic as fuel. That first move isn't opportunity, it's bait. The algorithm knows you're going to chase it because every trader believes the market moves on information. It doesn't. It moves because of timing. This is where most traders never look. The clock. The algorithm treats every scheduled event as a temporal access point, a moment when volatility can be justified. It has price levels predefined, liquidity pools, dealing range, highs and lows, inefficiencies waiting to be filled. All it needs is the element of time. When that timestamp arrives and time and price meet, that's when the algorithm executes its next sequence, not because of the news, but because the conditions are now aligned. On September 17th, the dollar index became the perfect example. At the exact FOMC release, price spiked aggressively, a violent sweep that cleared liquidity beneath the prior dealing range low into a predetermined price level that formed over 3 years ago. This intersection of time and price creates the input mechanisms for the algo to execute a command or an output. In the case of FOMC, repricing to the opposite end of the dealing range. Let me show you exactly how this played out on the dollar. Watch how the algorithm used FOMC as a catalyst to sweep one side of the market and then deliver the true move in the opposite direction. I'll walk you through it, and as you watch, remember this. It's not what happened that matters, it's when it happened. Let's jump into the chart. All right, so here we have an example of the dollar index on the daily time frame. Now, I want to draw your attention to this high, which is the highest high inside of all of this price action, and this low down here. Now, prior to this low being raided over here, this was the lowest low inside of all of this price action. But notice here that the body closed above the swing low of the dealing range low. Now, I'll get into the dealing range in a little bit, but what I first want to do is take your attention way back in time, all the way back to the end of February 2022. More specifically, this small area of price. This is known as a volume imbalance. And you can see that I've marked the high and the low of that volume imbalance. Now look closely. That volume imbalance sits inside of this last up close candle inside of this swing over here. So we ran lower, then ran higher. This becomes a reclaimed bullish breaker. Also note the body of this candle over here sits inside of that breaker's range. The midpoint of that breaker rests around that volume imbalance also. Now, if we go back to the current chart, note the reaction that we have inside of that breaker and the premium high of that volume imbalance. Let's zoom into this piece of price action on a 1 hour time frame and just look at that reaction here. Now, this low came in on Wednesday, the 17th of September at 2 p.m. What took place at 2 p.m. on Wednesday, the 17th of September? That's right, FOMC did. You can see at 2 p.m. we had the FOMC statement. Now we have time and price merging. We've got two input variables that are necessary for the algorithm to execute a command. The output in this case is going to be spooling higher. Now the opposite end of the range is up here where the dealing range high is. So what we can do here initially is we can grade this entire range from high down to low. We keep the dealing range low anchored at the initial dealing range. This here is a stop run. And again, that's confirmed with the close of the body. Now again, look closely. Notice that price runs higher and closes above the 25 DRT level, which is this lower quadrant. Again, I've done a ton of teaching on DRT and how to plot the DRT levels on this very YouTube channel, so I'm not going to go into more detail here. You can also download my free ebook, which you will find on my website, and that again will give you more information. Now notice what also rests at that 25 DRT level. We have the opening price of this down close candle that raids sell side liquidity inside of an extreme discount relative to this entire dealing range. Remember, the extreme discount is from the 25 DRT level to the dealing range low. The opening price is going to be our order block. Now, an order block is a block of time, and it's the change in state of delivery that forces price to change gears from a sell program going lower to a buy program going higher. So we anticipate this order block to form support. Not only that, at that 25 DRT level, we also have this sell side imbalance and this buy side imbalance forming a balanced price range. Now, this is a very strong algorithmic signature in price, and ideally, we do not even want to see price trade to the consequent encroachment. And as you can see here, the body's here telling the story that it does not want to close below that midpoint of that balanced price range. And we see this reaction higher. The next candle closes above the 50 DRT level. Again, this is confirmation that the market is bullish and we are inside of a buy program. The market retraces lower back into this down close candle that reacted from our previous order block, making the top half of this order block, these two consecutive down close candles, highly sensitive. We call this a propulsion block. Look at the reaction that we had from that propulsion block, hence the name, right? Now again, notice this candle over here. It closes above that 75 DRT level. Again, this is something that we want to see when we are looking for higher prices. This confirms bullish order flow, algorithmic order flow. Now watch what happens. The market retraces again lower into this reclaimed inversion fair value gap. And again, look where it rests, at that 50 DRT level. Note the body here. Does it close below the consequent encroachment or the midpoint of that gap? No, right? And then the subsequent move higher drops lower. Look at the reaction that we have at the premium high. So this is acting as strong support here, and again sends us higher, closing back above that 75 DRT level. Now we have utilized the 25 and the 50 DRT levels. At this stage, we should not anticipate a deeper retracement. What happens next? The market spools higher right for the buy side liquidity resting above the dealing range high. So FOMC initiated the buy program with time and price aligning. That creates a command to allow the algorithm to spool higher. So you see, the market doesn't care about headlines. It cares about data, time, and price. Every major event, FOMC, CPI, non-farm payroll, it's simply a timestamp for the algorithm to execute. While retail traders react to words, the algorithm reacts to alignment. Once you learn to see that alignment, you'll never chase that first move again. If you want to master how time and price create every move and see real-time examples like this FOMC, so click the link in the description and I'll see you soon.